Right, hey Mrs. Lake, it's me, it's Parker Wiltshire, and I know I use the TV for our group presentation, but I thought it'd be better if I just did this sort of thing for my individual concept. So I'd encourage you, if you watch, as you're watching this video, maybe have my slide presentation, which I shared with you via Google Slides, just kind of up there on the side, and you can go ahead and follow along. All right, so my concept was external financing and growth. And it kind of sounds a little fancy on the surface, but once you kind of dig into it, it's a pretty elementary concept when it comes to finances and economics. So let's start with what it is. What is external financing and growth? It's basically a reference to the idea that in order for financial institutions to grow and expand, they need money from outside sources. It's the idea that if you have growth, but you don't have enough money to properly expand and accommodate that growth, you have to find money from some sort of outside source. This is a concept that's really used by a lot of companies, a lot of churches, and it's a pretty simple concept when you really think about it. Now, there's basically three components of this concept. So if you're growing, and again, you need to accommodate this growth, and you're not really sure how you're going to do it, there's three avenues you can basically take. And there's short-term borrowing, which is, again, we think of things like short-term loans, such as a car loan or a loan that maybe you get for a furniture, a payment plan of some sort. Because again, this is a concept that even just individuals use. This is often used by companies, but it's really used in everyday life. Long-term borrowing, a great example of this would maybe be a church getting a mortgage for a new auditorium, just like Lancaster when they built the worship center. They didn't have $1 million just laying around to build this building. So they put some money down in a down payment, and then they borrowed the rest, okay? And then the last avenue that you could go would be to add more investors. If you add more investors, that brings in more capital, but it also brings in more voices. So you have to be careful of that. So you get more people from outside the company to pour in their resources into the company. So those are the three basic components of the concept. The overall significance of it is it's rather simple. Just the idea that, again, if you need to grow and you need to expand, you need to do some things in order to increase your profits and to accommodate the growth that you're seeing. You have to get money from somewhere. And whether sometimes that may not include this concept, sometimes it may include just maybe saving up profits for the purpose of using it later, those kind of things. But a lot of people like to go the routes of getting the appropriate loans and getting, again, those outside sources to fund this new coming in growth. Now let's take a quick look at this SWOT analysis. One of the strengths is that it accommodates growth. It allows companies to adapt quickly and to be able to expand in a way that, again, accommodates this new growth that's coming in, which will inevitably increase their profits. It gives a quick payoff. It enables companies to be able to pay off these loans quickly because as they grow, it brings in more profits, which enables them to pay back those loans rather quickly. And of course, it's got a long-term good. It's healthy for the company. It enables them sets them up well for more growth in the future. Again, some of the weaknesses: loan payments, buyer beware. Okay. While accommodating growth does increase profits, you have to ask yourself, is the profit that you're going to see as a result of this growth going to be worth the loan payments that you're going to make? And that's a question you always have to ask yourself when you're borrowing money. Investor dividends. If you go the route of investors, then those dividends that you're going to have to distribute are going to dip into those profits. Again, you have to ask yourself: do the benefits do the pros outweigh the cons? Essentially, that's what I'm trying to say. And then, of course, one of the other weaknesses would be interest. If you choose to go the route of loans accrue interest. You will always end up paying more than you originally bought the loan for. Okay? Opportunities. One of the great things that can happen as a result of getting a loan is you can establish good credit. As you establish good credit, this opens up a lot of doors for you in the future and enables you to, again, further your growth if you're able to manage your money wisely. Gives you expanded reach if you have investors. These investors have influences. They have a reach. They have people that they influence that can increase your profits even more. It's easier to sell. And as you grow, your brand name becomes more established, which makes it easier sell for investors, and it makes it way easier for you to get loans in the future. I'm sure that banks would agree that they're a lot more hesitant to give loans to the mom and pop shop down the street than they are if a representative from Walmart came in. It's again, like I've been saying this whole time, it's pretty simple. Now, threats. Unstable interest rates. Unstable interest rates can be huge. As the economy fluctuates, your interest rates likely will as well. The only way around this is a fixed rate loan. Of course, but that can be wise. It can also be not so wise. It means your rates never go up, but it also means your rates never go down. So you have to kind of know the state of the economy, kind of have to know where you're at financially. Incorrect projections is another threat. When it comes to external financing, because how many times have we seen it? Some company starts off, their profits are shooting through the roof. They're this brand new company. They open an extra 2, 3, 4 stores, assuming that those profits are just going to go up and up and up and up and up. And right as they get to that point, their profits plateau, they go under. Incorrect projections can kill a company when they make decisions, and big decisions, based on those projections. Okay, and then of course, conflicting interests. Investors, again, they all have conflicting voices, conflicting interests. This investor wants to take the company this direction. This investor wants to take the company this direction. Who do you listen to? Who has more influence? It can be difficult to do that there. Now, okay, who even uses this? A better question would be, who doesn't use this? Now, of course, we know of churches that do everything they can to when they buy a new building, they try to have all the money up front. But when it comes to if you look at any corporation, any company that has investors of any kind, they use this. They need money to grow, so they get investors. A church needs to expand. They've got people coming into their congregation. They're packing out their current building. Chances are they don't have $200,000 laying around to build a new building. So they have to get money from somewhere else. This is something that we even as people use. Your family grows, you need a new house. And so as a result, you gotta buy a new house. You gotta buy a bigger house, but you don't have $500,000 laying around because you have 5 kids. Okay. But really, again, external financing is something that really is one of those concepts that kind of makes the economic world go round, and it's pretty key when it comes to just kind of understanding the economic world around us. And it's really kind of as simple as that. All right, thank you so much, Mrs. Lake. I hope you enjoyed the presentation.